Hello, in this video, we're going to go through diluted earnings per share, specifically how to treat stock options. Let's discuss capital structure of a corporation. There's two different types. There's a simple capital structure and a complex capital structure. A simple capital structure is when a company has no outstanding securities that could potentially dilute or reduce their earnings per share. So what does that mean? This means if a company has nothing that would in the future potentially cause more common shares to be issued and outstanding, such as stock options. If a company issues stock options to their employees, then in the future, the employees have the option to buy shares at a specific price. And if they choose to do that, then there will be more common shares outstanding. Same thing, there's convertible bonds where a portion or all of the bonds will convert into a certain number of shares in the future, dependent on certain facts. So if a company has none of those types of securities, then they have a simple capital structure. If they do have even one of those types of securities, and there are several different kinds, then they have a complex capital structure. So why do we care about that? Because when we're talking about earnings per share, we're talking about there's two different kinds. There's the basic earnings per share, which is earnings available to common shareholders, which in turn really means net income minus any dividends paid to preferred shareholders or dividends owed to preferred shareholders, divided by the weighted average number of common shares outstanding. So in our EPS, which is earnings per share formula, the denominator is dependent on the number of common shares outstanding. And so in basic EPS, we have no sort of convertible securities that could potentially dilute that number of shares outstanding number. So when, like I said, the dilutive securities are types of securities that may become common stock through their exercise, conversion, or issuance. So we have our basic EPS, which ignores any of that because the company doesn't have that, or diluted EPS. And diluted EPS takes into account all the dilutive effects of these types of securities. If a company has a complex capital structure, they must report on their financial statement the basic earnings per share, where they ignore those securities, and the diluted EPS, where they basically they incorporate all of them. And again, examples of potential common shares that could be issued in the future are convertible bonds, convertible preferred stock, so that's preferred stock that have a feature that they could be converted into common stock, stock options, and these other contingently issuable securities. So there's just lots of different ones. We're not going to even focus on this one in the videos. So just as a visual, let's look about earnings per share. So our basic earnings per share right here is our calculation of net income minus preferred dividends divided by weighted average number of shares. And then the diluted takes this, plus you have to account for the impact of convertibles and the impact of options, warrants, and some other types of dilutive securities. So we're going to have two numbers. We're going to have a basic EPS and then diluted EPS that we need to report on our financials. Just note, we only report the diluted EPS if it is actually lower than our basic EPS. If companies will not report their diluted earnings per share if the securities make them anti-dilutive, which means they cause the diluted earnings per share to be higher than the basic earnings per share. So let's talk about how we treat options, rights, and warrants when it comes to calculating the diluted earnings per share. So options, rights, and warrants give the holders the right to exercise their option to purchase stock, usually at a specified exercise price. So we went, if you are not familiar with stock options, there's a separate video just for that. You can go back and watch. And then rights and warrants are, we're not going to go through what those are, but just know that they are different types of rights that are given where an individual has, or the company has a right if they're issued to a corporation. The holder has the right to exercise those option rights or warrants where they could potentially buy more common stock in the future, right? And so how do we, when we're calculating our denominator here, this is our denominator, how do we account for this potential additional shares of common shares outstanding? That's what we're trying to get to when we're talking about the diluted earnings per share. So the way we do it is we have to, because we don't know, will those options, rights, or warrants, will they be exercised? How many options will be exercised? We don't know. So in order to make companies comparable, right, against each other, even though this is not going to be perfect, the FASB said we have to assume that all the rights and all the exercises have happened at the beginning of the year, okay, or when those exercises were issued, whichever is later. Okay, so let's continue. How do we do this? And we do this by using what's called the treasury stock method. The treasury stock method says we assume that all the options were exercised, okay? And then, so if they were exercised, it means that we sold the stock and we received cash from that stock. And then we took that money that we received and we're going to buy back or reacquire our own stock using the average market price for the year. So let's go through an example. We have Sovereign Financial Corporation reported net income of $154 million in 2027. Its capital structure included the following. So here we have, they issued new shares, they sold new shares, they had a stock dividend, and they had some treasury stock. They reacquired 8 million shares in October. And then they have some preferred stock, non-convertible. This entire, every single one of these transactions is covered in the video for basic earnings per share to see how we come up with the average weighted outstanding common shares. So if you're not familiar with that, you have to go back because this whole video assumes you already know how to do that. And when we did that, we got our weighted average number of shares when we take into account all those transactions of 75,000 or 75 million. So back into when we're calculating our basic earnings per share, we got our earnings for common shareholders was $150 million, and our denominator, our average number of average weighted common shares outstanding was 75,000. So our basic earnings per share is $2. That means that for a shareholder, for every share they hold, they have $2 of earnings. That does not mean that's what they receive as a dividend. It's just the earnings. Now, let's just say that same example, but we have some stock options. An executive stock option granted in 2022, exercisable after 2026 for 15 million common shares at an exercise price of $20 per share. Okay, so now we have this company also granted stock options and they vested meaning they're exercisable after 2026, and we're talking about 2027. I want to point out that when we're talking about stock options or warrants or rights, the fact that they were granted is what matters when we're calculating our diluted earnings per share. Whether or not the recipient has vested in those grants is irrelevant. We just assume that they will vest and those shares will be exercised in the future, okay? So it just matters that they were granted. The fact, this example says that they had vested in those because it's after 2026, but it doesn't matter. If this said 2029, the facts would still be the same and would still assume that they were all exercised. The other piece of information that we got that's new is it tells us that the average market price of common shares during 2027 was $25 per share. So that was the average stock price for the year. So let's see. This treasury stock method says step one is we assume that all the shares that were granted for this stock option were exercised. So we were granted 15 million common shares, and the exercise price was $20. So if that happened, right, we sold all those shares for $20, we as a company would receive $300 million, and we would take that $300 million, those cash proceeds, and we would buy back our own stock, okay, which means that we acquire treasury stock and using the average market price per share for the year. So in this situation, we would take that $300 million divided by, we were told that the average market price per share was $25. So we would buy back 12 million shares. So now we've issued, right? We've sold 15 million shares, but we've purchased back 12 million shares. And so therefore, net, we've increased our number of shares outstanding by 3 million. And so this chart is in thousands. So here's my 3 million. I started with my 75,000 or 75 million, whatever you want to call it, of shares, weighted average number of shares outstanding. I add 3 million to it, and now I have 78 million shares outstanding weighted. So this slide is very busy, I know. Here's where we calculated our basic earnings per share, where we had the 75,000 or 75 million weighted number of shares outstanding, common shares outstanding. And in here, we take that same net income minus preferred dividends. This is the diluted earnings per share we're looking at now. And now our denominator is that 78,000 or million shares outstanding. And so our diluted earnings per share is $1.92. And in this situation, we would report the basic and diluted earnings per share on our financials because the diluted earnings per share is less than the basic. Also, I want to just point out on this slide that this is the way the book kind of goes through step by step of how to calculate the average, the weighted average common shares outstanding. And this is the same thing that I did on this table. It's just laid out differently. I personally didn't really like this, so I just created that table. But if this makes sense to you more so than the table in the previous slide, please by all means use this as your way of learning. Let's do a concept check. Corbin Company had 100,000 shares of common stock outstanding. Options to purchase 5,000 shares of common stock were outstanding at the beginning of the year. The options can be exercised to purchase stock at $50 per share. So that means that's our exercise price because they can buy stock in the future at this price. The average market price of the stock was $80. And the question is the net increase of incremental shares used in the dilutive earnings per share denominator is what? So now they want just the net increase, okay? Not the total number of weighted average number of common shares outstanding, just the increase. If we wanted to take the total, we would just have to add 100,000 to it. But let's see how we do that calculation. We're going to use our treasury stock method. Number one, we were granted 5,000 common shares, and the exercise price was $50 per share. So we assume we sold all those shares. So we received as a company $250,000. We're going to take that $250,000 and buy back our shares. That's where the term treasury stock comes in, treasury stock method, I mean. So we're going to buy back those shares using the $250,000 and using the average market price per share, okay? And so now we're going to buy back 3,125 shares. I want to make sure that you're not going to stop your calculation right there, because the question is, what's the net increase of incremental shares? Okay, so make sure you read your questions really closely, whether it's on an exam or the CPA exam, or a test you're taking for class. Make sure you read it very, very carefully to see what it is asking. So for us, the incremental increase is going to be the number of shares that we actually sold, right? Or that we assume was sold was 5,000, but then we bought back, we reacquired 3,125. So the incremental increase in the denominator is going to be 1,875. The total denominator for this company would be the 100,000 shares of stock that we had in the beginning of the year outstanding plus 1875. That would be our total denominator. It'd be 101,875, right? But that's not what it's asking, but it could ask that. So just be wary of that.